Let's start with a confession. Most people think banks are cold, rigid institutions that only lend to the rich or the already successful. That's a myth. Banks want to lend. That's how they make money. But they're also cautious, because bad loans hurt their bottom line. So how do you get a bank to say yes to your deal? You flip the script. You stop thinking like a borrower and start thinking like a partner. You stop chasing approval and start building trust. You stop pitching and start engaging. This video is your roadmap. We're going to unpack the psychology behind bank financing, the relationship building hacks that make you irresistible to lenders, and the exact steps to structure deals banks want to fund. Whether you're a real estate investor, entrepreneur, or small business owner, this guide will help you turn no into let's talk. Understanding the banker's mindset. 1. Banks are risk-averse by nature. Banks aren't venture capitalists. They don't want moonshots. They want safe, predictable returns. That means they're constantly asking, can this person repay the loan? What happens if they don't? Is there collateral? Is the business stable? Your job is to answer those questions before they ask. 2. What banks really want. Let's break it down. Track record. Have you done this before? If not, who's advising you? Collateral. What assets back the loan? Real estate, equipment, inventory? Cash flow. Can your business generate enough income to cover repayments? Character. Do you seem trustworthy? Are you organized, responsive, and professional? 3. The relationship factor? Here's the secret sauce. Banks lend to people they know. Relationship banking is real. If you're just a name on a loan application, you're easy to reject. But if you're a familiar face, someone who's been showing up, asking questions, and engaging, you're harder to turn down. According to Every Bit Matters, relationship banking is about personalized engagement. It's not just about transactions, it's about trust, loyalty, and mutual benefit. The relationship hack. How to build trust before you ask. 1. Start with small engagements. Open a business account. Deposit regularly. Use their services. This shows commitment. 2. Become a familiar face. Visit your branch. Attend events. Ask for your relationship manager by name. People lend to people they know. 3. Ask for advice, not money. Before you pitch your deal, ask for feedback. Would this kind of deal be something your bank finances? This invites collaboration and lowers defenses. 4. Use the power of referrals. If you know someone who's already financed by the bank, ask for an introduction. A warm referral can shortcut months of cold outreach. 5. Be transparent. Share your goals. Let them see your growth. Banks love transparency. It builds trust. As Enrichest points out, strong banking relationships are built on clear communication and mutual understanding. It's like nurturing a friendship. Structuring your deal to be bank-friendly. 1. The 5 C's of credit. Banks evaluate deals using the 5 C's. Character, your reputation and reliability. Capacity, your ability to repay. Capital, your investment in the deal. Collateral, assets that secure the loan. Conditions, market and economic factors. 2. Make your deal bulletproof. Include a detailed business plan, cash flow projections, market analysis, collateral details, risk mitigation strategies. 3. Speak their language. Use terms like DSCR, debt service coverage ratio, LTV, loan to value, ROI, return on investment. This shows you understand their world, and makes you easier to approve. The psychology of the pitch. 1. Frame it as a win-win. Don't just ask for money. Show how the bank benefits, interest income, long-term partnership, community impact. 2. Use social proof. Mention other investors, partners, or clients who are already on board. Banks love validation. 3. Be transparent about risks. Ironically, acknowledging risks makes you look more credible. Just be ready with your mitigation strategies. 4. Show commitment. Put your own money in. Offer collateral. Show skin in the game. The follow-up game. 1. Persistence without pressure. Follow up weekly. Share updates. Ask for feedback. But don't be pushy. 2. Offer to start small. If your deal is big, offer a smaller version. Let them test the waters. 3. Keep building the relationship. Even if they say no, keep engaging. Your next deal might be the one. Case studies, deals that got financed. 1. The real estate developer who started with a savings account. He opened a business account, deposited consistently, and built a relationship over 18 months. When he pitched his first deal, the bank said yes. 2. The tech startup that used a referral. They got introduced by a mutual client. The bank manager took the meeting, liked the pitch, and offered a line of credit. 3. The retailer who asked for advice first. Instead of pitching, she asked what kind of deals the bank liked. She tailored her proposal accordingly, and got funded. Tools, templates, and scripts. 1. Email script to request a meeting. 2. Deal summary template. Executive summary, market opportunity, financials, collateral, risk mitigation, ask. 3. Relationship tracker. Track meetings, follow-ups, feedback, next steps, what to do if they say number 1. Ask why, get feedback. Learn. Improve. 2. Try another bank. Different banks have different appetites. Don't take one, no, as final. 3. Keep building your profile, improve your credit score. Grow your business. Build more relationships. As CFO Center explains, understanding your bank's requirements and presenting yourself as a reliable partner is key to turning no into maybe, and eventually, yes, scaling the strategy. 1. Build a financing funnel. Engage with multiple banks. Track progress. Create options. 2. Leverage your success. Once one bank says yes, others will follow. Use your first deal as proof. 3. Teach others. Share your journey. Help others. It builds your brand and your network. Conclusion. Flip the script, own the process. Bank financing isn't just about money, it's about relationships. When you understand the psychology, build trust, and structure your deals strategically, you become irresistible to lenders. So stop chasing approval. Start building partnerships. Stop pitching cold. Start engaging warm. Make banks begin to finance your deals, not because they have to, but because they want to. Understanding banks can transform your approach to securing financing. Instead of viewing them strictly as a source of funds, consider how you can align your goals with their interests. Cultivating relationships and demonstrating reliability can improve your chances of success significantly, as banks are more inclined to finance those they trust and know well. Investing time in building these connections will serve you well in the long run. By applying these principles, you can change the way banks perceive your proposals and ultimately increase your opportunities for funding. The first step in your relationship building journey starts with small engagements. Open a business account and deposit money regularly. This simple act showcases your dedication. It's about establishing a presence. Frequent visits to the branch allow the staff to recognize you, transforming you from a nameless applicant into a valued customer within their eyes. Along this journey, always remember to ask questions about their services, as this demonstrates not just interest but also your desire to connect on a deeper level, building rapport that can pave the way for future lending. From there, you can take it a step further by requesting advice, not just funds. When you approach a bank representative, instead of launching directly into your proposed deal, frame your conversation around their experience and insights. Ask questions such as, what types of projects does your bank typically finance? Or, based on your expertise, do you believe my concept aligns with your priorities? By doing this, you not only gain valuable feedback but also position yourself as a collaborator seeking mutual benefit, which enhances your credibility significantly. To further strengthen your relationship with the bank, consider making personal connections within the organization. Introduce yourself to the bank staff and express genuine interest in their roles and experiences. Attend local events hosted by the bank, such as workshops or community gatherings, to familiarize yourself with the culture and meet decision makers. Small gestures can go a long way, like thanking your relationship manager for their time or sharing an interesting article related to your industry. These actions can create a sense of camaraderie, reinforcing your commitment to build a partnership rather than merely seeking a transaction. Over time, this genuine engagement can foster loyalty, making it more likely for banks to support your future financing needs. The next critical step in demonstrating your commitment to the bank is to maintain open lines of communication. Regularly follow up with personalized updates about your business, even when you're not actively seeking funding. This ongoing interaction helps to solidify your relationship, as it showcases your dedication and willingness to keep them in the loop regarding your progress. Engaging with the bank in this manner not only keeps you on their radar but also positions you as a proactive partner. As you venture deeper into your relationship with the bank, it's essential to clearly articulate the value you bring to the table. Prepare a detailed business plan that doesn't just outline your goals but also explains how the bank's support will contribute to achieving those objectives. Emphasize elements like market potential, customer demographics, and financial forecasts that demonstrate a solid understanding of your business landscape. When lenders see that you've thoroughly researched and planned your proposal, you signal your seriousness and dedication to making the venture a success. This detailed presentation can help shift their perception from viewing you as a risk to seeing you as a promising opportunity worth investing in. Over time, with consistent effort and strategic engagement, you can not only secure funding but also foster a lasting partnership that benefits both you and the bank. To further enhance your pitch, it's vital to speak their language. Familiarize yourself with financial terms that resonate within the banking industry, such as DSCR, debt service coverage ratio, LTV, loan to value, and ROI, return on investment. When you incorporate these phrases into your discussions, it demonstrates that you've done your homework and increases your credibility as a potential borrower. Banks are more willing to lend when they see that you understand their metrics and considerations, making your proposals not just appealing but also comprehensible within their context. As you prepare your pitch, remember that framing your request as a win-win scenario is crucial. Instead of merely detailing how much funding you need, illustrate how financing your project will not only yield returns for you but also benefit the bank in the long term. Explain how the partnership can lead to interest income for them, contribute to community development, or enhance their portfolio with your success story. This approach can effectively shift their mindset from viewing you as a risk to perceiving you as a valuable ally ready to drive mutual growth and prosperity. To solidify this win-win perspective, emphasize the social proof surrounding your project. Mention other reputable investors, partners, or businesses already involved, as this validation can significantly influence their decision-making process. Additionally, remain transparent about the inherent risks while presenting your strategies for mitigation. This honest approach not only builds credibility but also allows you to demonstrate preparedness and responsibility, essential traits that banks look for in a borrower. As you craft your narrative, focus on illustrating commitment through personal investment, showing that you have skin in the game, ultimately increasing your appeal to lenders who appreciate this shared risk. Case studies illustrate the effectiveness of these strategies. Take the example of a real estate developer who transformed his relationship with the bank over time. He began with a simple savings account, consistently depositing funds and establishing a routine presence at the branch. After 18 months of nurturing this connection, he confidently presented his first project proposal, resulting in the bank enthusiastically saying yes. Similarly, consider the tech startup that gained a significant advantage through a warm introduction from a mutual client. This connection opened doors and led to a successful line of credit after a positive pitch. Lastly, a retailer took a different approach. By proactively seeking the bank's advice on what types of deals they preferred, she crafted a tailored proposal that resonated well with the bank's interests and secured financing. Each case underscores the power of building relationships, understanding the bank's perspective, and engaging meaningfully to turn aspirations into funding realities. Nurturing these banking relationships is not a one-time effort but an ongoing journey. Keep the connection alive by regularly sharing updates and milestones in your business. This not only reinforces trust but also demonstrates your commitment to transparency. When banks feel included in your journey, they're more likely to view future proposals favorably, seeing you as a partner rather than just another borrower seeking funds. Over time, as these foundations strengthen, you will discover a network of support, turning the once daunting task of financing into a collaborative dialogue. Embrace this approach, and soon, opportunities will blossom before you. When you encounter rejection, don't let it dishearten you. Instead, view it as an opportunity for growth. Begin by asking the bank for feedback to understand their reasoning better. This insight can be invaluable for improving your proposals in the future. If a particular bank isn't aligned with your vision, don't hesitate to explore other institutions that may be a better fit. Each bank has its own unique lending appetite, and persistence is key. Focus on refining your profile by enhancing your credit score and strengthening your business model, which positions you better for future financing discussions. By flipping the script and transforming your approach to bank financing, you can cultivate meaningful partnerships that yield mutual benefits, fostering an environment where both parties thrive. Remember, the journey from no to yes relies on trust, transparency, and genuine engagement, allowing banks to see you as a valuable ally and success.